Welcome to the deep dive.
Okay.
If you've been watching the markets lately, you know we are sitting right in the middle of November 2025.
Yeah.
And we're navigating what has been a truly chaotic post-Halloween crypto environment.
That's putting it mildly.
We've seen just incredible volatility, sharp dips, tentative rallies, and enough uncertainty to make even, seasoned traders a bit nervous.
It has been quite a ride, especially for Ethereum. Right now, it's sort of hovering around that $2,900 mark.
And that's after absorbing a pretty severe drop.
Oh, yeah, a 30% drop just over the last month. That kind of volatility really makes everyone pause and just wonder, where is the real bottom?
Absolutely. And right into this moment of market anxiety steps one of Wall Street's most respected veterans with an an unbelievable claim.
Right.
That Ethereum, ETH, is not just going to recover its losses, it's going to catapult to somewhere between $7,000 and $9,000.
And the timeline.
The timeline for this.
Yeah.
By January 2026.
That is a colossal jump.
Yeah.
We're talking about a potential 140% upside in barely 2 months.
So what makes this prediction so compelling is the source.
It's Tom Lee. He's the CEO of BitMine and co-founder of Fundstrat. So this isn't just hype from nowhere. It's coming from a very, very serious place.
Exactly. So our mission today is to cut through all that noise and figure out the evidence. If a Wall Street titan is making a bet this aggressive on this tight of a timeline, what does he know that the rest of us might be missing? We're using the stack of sources, the hard data, the academic analyses, and macro trends to really unpack the foundation of this $7,000 prediction.
And we absolutely have to start by just confirming the weight of the messenger. Lee is not just some analyst.
No.
He's a giant of traditional finance, an ex-JP Morgan analyst, co-founder of Fundstrat Global Advisors, a firm that literally advises massive institutional players. When he speaks, capital listens.
And what's so unique here is that he isn't just offering commentary from the sidelines.
Not at all.
He's the chairman of a major operating company, BitMine Immersion Technologies, and they are actively right now accumulating Ethereum.
Their holdings are massive. They hold 3% of the total ETH supply. That's over 3.6 million tokens.
Which is valued at more than, $11 billion?
$10.9 billion, yeah. And think about that scale for a second. His company isn't just passively holding this.
No, it's an active strategy.
Their stated corporate goal is to increase their holdings to 5% of the total supply. So when he publicly says ETH could touch bottom in $2,500 and then shoot up to $7,000, $9,000, you have to recognize this isn't just market chatter.
It's a strategy.
It's a strategy underpinned by billions of dollars of institutional investment.
So if you are the learner navigating this volatile market, understanding the evidence that justifies that colossal jump is everything. Let's start with Lee's own credibility. Why should we pay attention to him specifically?
Well, it really comes down to his track record and his methodology.
He's called some big moves before.
He really has. He's successfully predicted major market moves where others just saw noise. Go back to 2017. He called Bitcoin hitting $55,000 when it was trading way down at $2,000.
And he smashed it.
Smashed it. And more recently, he was on the mark with Bitcoin hitting $100,000 back in 2024.
And what's important here, I think, is his approach. It's consistently rooted in macro data, institutional money flow.
Yeah.
He looks at foundational shifts, not just, temporary chart patterns or sentiment.
Exactly. He's analyzing the plumbing of the financial world. And right now, his company is proving their conviction with their actions.
Right.
BitMine made a huge purchase of 14,618 ETH for $44 million just a few weeks ago, November 27th.
And that activity is a classic signal of what people call smart money accumulation.
Yes, smart money, meaning they're using market dips that are caused by retail fear as their prime buying opportunity.
They're doing the exact opposite of the average fearful investor. And Lee has this amazing frame for this whole period.
The ChatGPT moment.
The ChatGPT moment for crypto.
And that analogy is just brilliant because it captures the idea of a fundamental shift in utility. ChatGPT suddenly took this niche tech large language models and made it indispensable globally almost overnight.
And Lee is arguing Ethereum is about to do the same.
Exactly. That it's about to cross a similar threshold, transitioning from a niche asset into basically essential institutional infrastructure. And that is what will attract massive capital inflows.
That sets the stage perfectly for our analysis. So let's look at the drivers Lee believes will push ETH from around $2,900 to $7,000 in such a short window. We've synthesized the sources into 3 core pillars.
Okay, starting with pillar 1, the super cycle of tokenization.
This is the big idea, the idea that Ethereum is transforming from mainly a consumer app platform into the core settlement layer for traditional finance.
And when he says super cycle, he means this is not a short-term trend.
Yeah.
This is a decade-long shift in how global assets are owned and traded.
So for you listening, to explain tokenization simply, we're talking about taking assets, real-world assets, or RWAs.
Things like bonds, stocks, real estate, even gold.
Right. And representing ownership of them securely on a blockchain. Lee views Ethereum as the neutral chain with 100% uptime, which makes it the ideal, reliable settlement layer for all these assets.
And this isn't theoretical. We have institutional giants already doing it. BlackRock, the largest asset manager in the world, managing over $10 trillion, has already begun tokenizing funds on the Ethereum chain.
That's the most powerful signal you can get. The $10 trillion monster is on the move.
And that's where the academic evidence really backs up Lee's whole thesis. A key paper from 2023 from the Journal of Financial Economics. It isolated the exact financial incentive driving this institutional shift. And what they found was really astonishing.
Which was what?
That permissionless blockchains like Ethereum reduce the transaction costs for tokenized finance by a significant 40 to 60%.
Wow, that is a massive discount. In finance, where, tiny margins dictate everything, a 40 to 60% reduction in cost isn't just an incentive, it's an imperative.
Precisely. If you are a trillion-dollar institution and you can reduce your operational costs by half just by moving settlement onto Ethereum, you are going to attract trillions in capital from others who have the same cost-saving mandate. That volume, that efficiency, that's the fuel for the $7,000 target.
That's a powerful tech argument. But Pillar 2 is all about what's happening in Washington and Frankfurt. Favorable macroeconomics.
This starts right at the bottom of the price chart. Lee specifically cited analyst Tom DeMark's view that $2,500 is the critical capitulation point.
So for the learner, a capitulation point is that brief, painful moment where forced sellers investors who are margin called or just panic selling are completely flushed out.
It's the final surrender. It's the point that usually signals maximum fear, and it almost always precedes a strong rebound because all the weak hands are gone.
So if the price touches $2,500, Lee sees that as the last big buying opportunity before the institutional rebound begins.
And that rebound is fueled by global policy. IMF projections are strongly suggesting that the Fed will maintain a dovish stance into 2026.
Meaning rate cuts.
Anticipated rate cuts, down to the 3–4% range.
Yep.
And historically, when central banks ease liquidity and lower rates, investors exit low-yield safe assets like T-bills and move right into higher risk, higher reward assets.
Like growth stocks, or in this case, crypto.
And we don't have to guess about the impact. There was a powerful study from the University of Chicago in 2024 that modeled this exact dynamic.
What did it find?
That study showed how low-yield environments, similar to what's projected for COM26, historically correlate with a staggering 150% rise in alternative assets like ETH. And they base this on data from the last major low-rate cycle between 2017 and 2021.
So the macro setup is a perfect tailwind for Lee's prediction.
It is. And there's another layer here.
Which is?
Ethereum has strong historical precedent. Data confirms that ETH typically outperforms Bitcoin in the fourth quarter. We're talking about an average historical increase of 120% for ETH versus 80% for BTC during that period.
Plus, you have to factor in the yields.
Right. Ethereum staking currently offers a yield of around 4% to 5%. In a world where risk-free bonds might be yielding 3%, Ethereum staking starts looking incredibly attractive to institutional treasuries. It acts like a turbocharged high-yield bond.
So it's drawing institutional money from two sides. The cost reduction side, that's Pillar 1, and the yield and macro side, Pillar 2.
Exactly.
All right, let's move to Pillar 3, technical structure and network effects.
Technically, the charts are setting up nicely. ETH recently broke above what analysts call a 100-day descending wedge pattern.
Okay, for listeners who aren't deep into technical analysis, what exactly is a descending wedge?
Just think of it visually. The price is making lower highs and lower lows, squeezing into a narrow point. It suggests that the continuous selling pressure is finally drying up.
So the range is shrinking.
The range is shrinking, and according to TradingView data, once that upper trend line is broken, the pattern is historically bullish in about 80% of cases. It signals a major reversal is coming.
So the chart itself is signaling that selling pressure is exhausted, which backs up Lee's idea of a capitulation bottom.
And smart money is confirming the support level?
Right.
Data from CryptoQuant in November 2025 shows that support at the $2,800 level aligns almost perfectly with the realized prices of major whales.
Let's break that down. Realized prices of whales. What does that mean for someone just watching the charts at home?
It's basically the average cost basis, what the largest holders, the whales, actually paid for their tokens.
Okay.
So if the price drops much below that $2,800 level, these massive institutional holders are underwater. They're sitting on losses.
And you don't want that.
No, they are financially and reputationally motivated to defend that line aggressively to avoid realizing losses, which provides a natural, strong floor for the price.
Now, here's where the argument becomes, well, exponential. A fascinating 2025 paper out of MIT used complex network models to analyze growth.
And they found that Ethereum's massive developer base, which is 40% of the entire global crypto ecosystem, generates what they call exponential network effects.
This is the long-term engine.
It really is. The more developers you have building on the chain, the more use cases are created. The more use cases, the more users and institutions get attracted. And the more users, the higher the ultimate network value.
It's a self-reinforcing loop.
A virtuous loop, exactly. The MIT research suggests that this network effect, driven by institutional adoption, could potentially triple the value of the entire network.
Which connects directly to the price prediction.
Yeah.
And we can't forget that the network's utility is about to increase dramatically. Vitalik Buterin recently announced scaling upgrades.
Designed to triple daily transactions sometime in 2026.
So utility and capacity are both increasing, just as that tokenization demand is set to explode.
So if you synthesize all this, we have a clear multi-layered argument. We have the technological imperative for finance pillar 1, the macroeconomic necessity for yield pillar 2, and the technical confirmation of a reversal pillar 3. It actually makes the $7,000 target sound achievable, not just aspirational.
Agreed. But armed with that knowledge, we would be doing you a profound disservice if we didn't equally scrutinize the risks. The road to $7,000, even if the stars align, is full of potential potholes.
Absolutely. It's crucial to analyze the risks, ensuring you're armed with critical knowledge, not blind emotional conviction, before you navigate these volatile markets.
The first major challenge has to be macro volatility. Lee's whole thesis rests on the Fed continuing its path towards rate cuts in 2026.
It's a huge assumption.
It is. If the Fed unexpectedly stalls those cuts, say due to a new inflation spike, which Bloomberg analysts put at a 25% probability, that momentum could halt immediately.
And we know exactly how bad that can be. A 2024 NBER study showed that historical inflationary shocks have the power to cut crypto rallies by as much as 50%.
50%.
So if the macro environment turns against this narrative, the $7,000 target could easily get cut down to $3,000 or $4,000. The rally is heavily dependent on that dovish monetary policy.
Okay, challenge 2, competition and market fragmentation. Ethereum, for all its dominance, is facing aggressive competition.
From other high-speed Layer 1 chains like Solana and dozens of specialized Layer 2 scaling solutions.
So Ethereum has to succeed in implementing its planned upgrades, like the Prague upgrade in 2026, to ensure it stays scalable and cost-efficient.
Right. The Harvard Business Review published an analysis in 2025 warning that excessive market fragmentation, where users and developers scatter across too many different chains, can actually reduce the total network value by up to 30%.
So it has to maintain its dominance.
It has to maintain that unified ecosystem, or the value proposition starts to erode.
And finally, challenge 3, regulatory hurdles.
Always a big one.
Institutional inflows are dependent on regulatory clarity. Any potential SEC action on stablecoins, which are integral to on-chain finance, or delays in anticipated products.
Like the BlackRock request for a staked ETH ETF.
Right. That could severely curb institutional enthusiasm. If institutions can't easily and legally access staked ETH, a massive element of Pillar 2, the yield play, just disappears.
And we can't ignore the psychological floor Lee himself mentioned. $2,500. A drop of 13% from where we are now could trigger a massive wave of retail panic selling, regardless of the fundamentals. You need to be prepared for that possibility.
So what's the final takeaway here? Lee's call is extremely aggressive, especially with the short timeline, but it's clearly not baseless speculation.
No. He is focused on the long-term structural inevitabilities, the massive institutional adoption mandated by cost reduction, and the macroeconomic alignment from low rates. He is not just betting on a price. He's betting on Ethereum becoming global settlement infrastructure.
So the verdict is that the $7,000 target is supported by substantial institutional activity. Bitmine bought hundreds of millions in November alone, and by verifiable academic evidence.
A 140% upside from $2,900 is entirely plausible during the historical bull run dynamics of a Q4-Q1 period, assuming the macro environment stays supportive.
This means the current volatility, especially if it dips toward that $2,500 capitulation point, could be seen as an opportunity.
But that window is tight, and patience and risk management are absolutely non-negotiable.
And that means sticking to the fundamentals of investing. Ensure you have proper diversification, and especially in a market this volatile, always use tools like stop losses. Never let FOMO override your risk management strategy.
No matter how enormous the projected upside looks, the knowledge here is the real asset.
Exactly. Instead of fixating solely on the volatile price prediction, will it hit $7,000 or $9,000, we encourage you to focus on the investment Tom Lee is actually making. He is betting on the structural shift, the massive supercycle of tokenization colliding with favorable monetary policy. He is investing in a change of infrastructure, which drives value regardless of weekly market noise.
The best investment you can make is the one that deepens your understanding of those structural changes, because that knowledge is what truly gives you the foresight to stay ahead of the curve long after that January 2026 deadline passes.
Until the next deep dive, keep learning, and may your knowledge be your greatest compounder.